Students usually memorize the golden rules of accounting but still get confused while passing journal entries. That's because they learn the rules, but not the meaning behind them. In this video, we will break down each golden rule in simple words, explain why it exists, and connect it to real-life transactions with 2 detailed examples per rule. Rule 1. Personal account. A personal account is related to people or organizations we interact with in business. This includes individuals, firms, banks, creditors, debtors. Whenever a person or organization receives something from the business, we debit them. Whenever they give something, we credit them. Rule: debit the receiver, credit the giver. Why this rule? Think of it from the business's viewpoint. When someone receives value from the business records the receiver as debit. When someone gives value to the business records the giver as credit. This keeps track of who owes whom. Examples. You pay Arun 500 rupees. Here, Arun is the receiver of money. When a person receives a benefit, his account must be debited. Cash goes out from the business, so the business gives value, and the giver is credited. Entry. Arun account debit. To cash account. To customer Ravi pays you 2000 rupees. Now Ravi is the giver because he is paying you money. The business is receiving the value, cash, so first we debit cash. Since Ravi gives value to the business, we credit Ravi's account. Entry. Cash account debit. To Ravi account. Rule 2. Real account. Real accounts are related to assets, things, and properties of the business. These are items that the business owns, such as cash, furniture, machinery, vehicles, computers, buildings, land, tools, stock. Real accounts reflect physical or intangible things. When these assets enter the business, we debit them. When they leave the business, we credit them. Rule: debit what comes in, credit what goes out. Why this rule? The business must always track its assets. If something comes into the business, it increases the business's value. So debited. If something goes out, the business loses value. So credited. Examples. Business buys a computer for 40,000 rupees. Computer is an asset. Since this asset enters the business, it must be debited. Cash is going out to purchase it, so cash is credited. Entry. Computer account debit. To cash account. To business sells old furniture for 5,000 rupees. Furniture is an asset. The asset goes out from the business, so we credit the furniture account. Cash comes into the business from the sale, so we debit cash. Entry. Cash account debit. To furniture account. Rule 3. Nominal accounts. Nominal accounts deal with the financial performance of the business. They track all the day-to-day expenses, losses, incomes, gains. Nominal accounts ultimately decide the business's profit or loss. Rule: debit all expenses and losses, credit all incomes and gains. Why this rule? Expenses and losses reduce the profit of a business, therefore they must be debited. Incomes and gains increase the profit, therefore they must be credited. This helps prepare the profit and loss account correctly. Examples. 1. Paying salary 10,000 rupees. Salary is a daily business expense. Any expense causes the business to lose money. Therefore, salary must be debited. Cash is paid out, so cash is credited. Entry. Salary account debit. To cash account. To business receives commission 3,000 rupees. Commission is income for the business. Any income increases business profit. Then credit it. Cash comes into the business, so cash is debited. Entry. Cash account debit. To commission received account. Summary. To make accounting simple. If a person receives, debit them. If they give, credit them. If an asset comes into the business, debit it. If it goes out, credit it. If the business spends, debit it. If the business earns, credit it. These 3 are the golden rules of accounting.